And David, let me start there. And I think this tells a big picture. We're going to bring up a chart of historical operating margins. They haven't been this high. I don't know. Your chart went way back. We took it from 2016. What's going on here? And can these kinds of margins continue?
Yeah, thank you for having me on, David. We've got this chart since 2000. We just shared with you the last number of years. The operating margins are the highest they've ever been. Obviously, they're not going to continue into the future as you get more inventory. Over time, that means that you have, reduced pricing power. But right now, you're going through this incredible, we spoke about this with you since last year, this incredible sort of retail surge in the economy where it's actually quite staggering. And what's actually happening, the operating margins at the highest, but at the same time, we're in a situation because of COVID of total disequilibrium in the marketplace. Disequilibrium with restaurants, airlines, car companies getting cars, people to come back to work, and also inventories. So it's creating all sorts of funky stuff. But for retail, it's absolute nirvana right now. There's not a single retailer. We track every retailer. We look at the cash. And every year, there's always a few that we think might have problems from a bankruptcy standpoint. We do not see a single retailer right now that is imminent bankruptcy. So it's really the best of times right now.
Yeah. Any of our viewers who followed you through the years and these interviews that we've done would know that you typically look at a company a retailer that has high inventories as a potential caution sign because that could lead to markdowns in the future. But that's kind of turned on its head now as we head into the holiday season, isn't it, David? You track so many of these retailers who show incredibly low inventories, but it would seem those perhaps that have more inventory may be in a better position. Will you explain?
Yeah, it's a little bit sort of somewhat complicated, but not really. First of all, you always want to try and invest in a retailer that's got its inventories well controlled. Because when the inventories are well controlled, that means it doesn't need to take markdowns. And the gross margin will be higher, and they'll probably have higher operating margins. We are finding that because of COVID, from 2 years ago, year and a half ago, we found that inventories just shut down. The shipping shut down, production shut down to a large degree. So we don't have inventory. For the most part, inventories are much lower than sales growth. But because of what the Fed's done, and everyone's got money and feeling comfortable and confident, the demand has been humongous, absolutely humongous. So according to our chart, we've been doing this for 20 years for every retailer, total sales growth, and I'm talking about not including Amazon because of the inventory reasons we keep that out. So total growth rate of inventory for the last quarter just reported was up 8%. That's an average for 2 years because of COVID, we have to average it. And inventories are up 4%. So that's a 4% spread, and that's a positive spread. It means that there's too little inventory in the system. And of course, our models can tell you how much inventory, how much it's too low. It's been low for many, many quarters now. And that means that it should mean that we are going to most definitely have fantastic gross margins heading into Christmas. There's not even an issue on that. So in terms of jumping ahead here, David, I know you love to talk about Christmas and maybe we're jumping ahead, but
go ahead.
That means that for Christmas, the earnings of the retailers will be super high from a gross margin standpoint. But the other part of the profit and loss account is the expenses. That would be freight and things like that, cost of labor. Input prices are not a big factor at the moment. That'll be a bigger factor with inflation of those prices for next year. So we don't know how much freight is going to extra cost and wages to bring it over here. That's going to impact some of the companies when they report in the next few weeks in terms of lowering expectations for P&L at the bottom line. But I really believe that the gross margin will be stronger than ever. And that's really a powerful thing. And we'll get the retailers even more cash than they've already been accumulating in the last few years.
Right.